Hello guys, my name is João Paulo and today I will talk a little to you an overview about financial management. Our agenda is composed of four modules. Module 1, Fundamentals of Financial Management. Module 2, Cash Flow. Module 3, Stocks and Bonds. And Module 4, Financial Ratios. Then, we go to Module 1, Fundamentals of Financial Management. First, let me ask, what is finance? When we talk about finance, the first thing we think is money, okay? But finance also deals with the investment issue and why someone, company, individual, and government purchase money, which is called capital. Finance is divided into three main groups: corporate finance for companies, personal finance for individuals, and public finance for governments. And the main focus of finance is investment management for individuals, asset management for institutions, and associated activities, trading and correction of stocks, investment banking, and risk management. An important theory addressed by finance is the question of time value of money. This is an important concept that will assist you in making financial decisions. For example, take a loan or a discount purchase. After all, what is financial management? Financial management is a vital activity in a company which covers the processes for planning, organization, controlling, and monitoring of resources. In other words, it's the use of the principal financial management to achieve the company's objectives and goals. Some financial activities in organization: purchasing of funds, accounting, form of payment, risk assessment, and the others. Now let's talk about forecasting. Financial forecasting is a tool used for companies to define their goals and objectives. It's vital in the planning of the company and uses data from the past and the present to predict the future performance of the company. Components of financial forecasting. These elements feed into a financial forecast: monthly financial statements, risk and opportunities on the horizon, actions to minimize risks and capitalize on opportunities, resources available to bring the correct forecast, and obstacles that may arise and plans to overcome them. Now I will talk to you about budget. Budget is spending plan in a period of time based on revenue and expenditure. It's an important tool that can help the company use their resources in the best possible way. And we have some types of budgets. Are they forecast budget, performance budget, and cash budget? Next term is debt and credit. Debt and credit are complementary terms. Debt is the money you lend and is already paying with interest. For you to acquire this loan, you must the bank loan and have credit. The most popular form of credit is the bank loan, which is used for mortgages, car loans, and credit lines. Example of debt: a car loan or a balance on your credit card. Example of credit: car loans, mortgages, and line credit. Now, the 10 principles of financial management. Principle 1, risk-return trade-off. Number 2, time value of money. Number 3, cash not profit is king. Number 4, incremental cash flows counting. Number 5, the curse of competitive markets. Number 6, efficient capital markets. Number 7. Agent's problem. Number 8. Taxes based business decision. Number 9. All risk is not equal. Number 10. Ethical dilemmas are everywhere in finance. These are the principles that guide financial management and its decisions. In Module 2, I will treat a very important theme, the cash flow. But what is cash flow? Cash flow measures how much money is moving into and out of your business during a specific period of time. It is an entry and exit movement of money. Cash flow are measured generally monthly or quarterly. Now, and free cash flow. What is this? The free cash flow is used to measure a company profitability. It's the available reserves that will be used to pay investors and shareholders, represent how much money is available for investment. In Module 3, I will talk to you about a very important subject in financial world, stocks and bonds. Stocks are securities that represent the property of a fraction of the company. This fraction can be small, few stocks, or large, many stocks. Therefore, the owner of stocks shall participate in the company assets and profits. Stocks are usually purchased and sold on the stock exchange. For example, Bovespa in São Paulo, NYSE and Nasdaq in New York, Latbex in Madrid. But there can also be private negotiations in secondary stock market. Common stocks versus preferred stocks. Now, I will explain two types of stocks, common stocks and preferred stocks. Common stocks give right to vote in general meetings and to receive dividends paid by the company. Preferred stocks generally doesn't give the right to vote in meetings, but give the right to a bigger claim on assets and profits and also have priority in the event that a company goes bankrupt and is liquidated. And bond. What is this? Bonds are in the class of assets. Investors purchase company and government bonds for a determined term. Remuneration is made by interest and capital at the end of the term. The bonds work like a balance sheet when the stock market is not going well. Now, some quick facts about bonds. Definition. A bond is a loan to company or government that pays investors a fixed rate of return over a specific time frame. Average returns. Long-term government bonds historically earn around 5% in average annual returns versus 10% historical average annual return of stocks. An example is American government bonds. Risks. A bond risk is based mainly on the issuer's creditworthiness. That is, the better the finance of a company, the more secure the operation will be. Advantages. The related safety of bonds help balance the risks associated with stock-based investments. Now, the pros and cons of bonds. Pros. Bonds are relatively safe. Bonds are a form of fixed income. Cons. Low interest rates. Some risks. Financial ratios. Let's talk in details of some terms. First, I will talk about rate of return. A rate of return, ROR, in abbreviation, is the net gain or loss of an investment over a specified time period. A rate of return can be applied to any investment from real estate to bonds, stocks, and fine art, for example. The rate of return, ROR, given by the following formula How to evaluate a project? To help us to evaluate a project, we have some ratios. I will speak now a little about it. I will start with net present value, NPV. In the value of all future cash flows, positive and negative, over the entire life of an investment discounted to the present, is used in finance for determining the value of a business, investment security, capital, project, new venture, cost reduction program, and everything that involves cash flow. The next ratio, rate of return. Internal rate of return is a discount that makes the net present value of all cash flows, both positive and negative, equal to zero for a specific project or investment. The ERR estimates a project break-even discount rate or rate of return, which indicates the project potential for profitability. Now, the payback period. The payback period refers to how long time it's necessary to recover the cost of an investment. How much shorter the payback is more desirable the investment. Conversely, the longer is payback, the less desirable it is. Now, its conclusion. In current days, knowledge of financial management is something essential, and in the corporate world, companies that have a serious financial policy will always be seen with good eyes by the public. Thank you.